Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes boring, sometimes scary, but always important language of corporate filings. Today, we're diving into GP Act 3, Accession Corp's latest 10K report. That's their yearly financial health checkup. And let me tell you, with blank check companies, sometimes the real treasure is buried in the fine print, not in the deal itself. So let's see what's happening. This report covers their activities for the year 2024, and okay, I'll tell you. GP Act 3 is a blank check company, also known as a special purpose acquisition company or SPAC. Basically, they're a shell company, meaning they don't have any real business operations themselves. They are waiting around for a business combination with a real operating company. Our job is to assess all the risks associated with that. They went public in May of 2024 with the aim of finding a business to merge with. Think of them as corporate matchmakers. One of the first big risks with these companies is simple. It is whether they'll even be able to find a good company to merge with. They have to choose a business that makes sense and they have to be able to complete the deal, which is tough. They're in a competitive market. A lot of other SPACs are all fishing in the same pond. Scroll December 31, 24 New Max fall. All right, let's get into the financials. The company reports a net income of $8,671,665 for $2,026,638 in interest account. Remember, that's from their IPO. It isn't like they're selling a product, just earning interest waiting for a target. All that was partially offset by $500 from their IPO. It isn't like they're selling a product, just earning interest waiting for a target. All that was partially offset by $564,975 in cost for things like organizing themselves and keeping the lights on. That's interesty $4,974 lies on. That's interesty $4,970 for contrast. In costs for things like organizing themselves and keeping the lights on. That's interesting to contrast with 2023, where they had a net loss of just $14,041 in themselves and keeping the lights on. Looking at their assets, we see most of the money is tied up in that trust account we just mentioned. We're talking $296,736, $636,638 As of the end of 2024, they have just under $500,000 in actual cash. But that trust account is the big enchilada. On the liability side, they have a few items. First of all, they had $231,605 in accrued expenses, which are bills that they need to pay. Then they've got $400,000 in promissory notes, which are promises to pay back money to some related parties, basically people connected to the company. Interestingly, this is down from the 6028 money to some related parties, basically people connected to the company. Interestingly, this is down from the 6020 Saya. The company has a total liabilities of about $14.7 million. So when we look at the company itself, what's left over for the shareholders? Well, it's not too pretty. They have a shareholders deficit of over $13.9 million. But before we get too worried, the too worried, 636,636,636,636. This means the value that investors could get at any time is excluded. Now let's move to the fun part, risks. It's like the what could go wrong section of the manual. A big one, as it is for all SPACs, is that if third parties bring claims against them, the money in that trust account could shrink. So they might have less to use for a merger or less to give back to shareholders if they can't find a deal. Geopolitical risks are on their mind too. Conflicts in Ukraine and the Middle East could throw a wrench in their plans, making it harder to find a suitable business or make deals. The same can be said with pandemics. Here's a juicy one. The sponsors, those are the guys who set up the SPAC, they could have a conflict of interest. If the SPAC doesn't complete a deal, they basically lose their entire investment. So they might be tempted to push through a deal that isn't so great for regular shareholders just to avoid that loss. The report lays out other conflicts of interest and potential conflicts. The officers aren't working on this full time, they work on other projects. It's possible they won't spend enough time or resources on finding a business combination target. There could be issues that affect all the SPAC's founders. It's a fact that founders will be able to make back their investments even in cases where common shareholders would not, which raises questions and concerns about the alignment of interests. Lastly, there are risks associated with NASDAQ that I'm sure all shareholders are mindful of. The report mentions that they are following all the requirements to be listed or to remain listed. Alright, let's zoom in real quick on what they're paying their accountants. The audit fees, that's for checking their financial statements, totaled around $165,000, $365,000, $365,000, $365,000, $365,000, $317. They don't have anything to disclose here, which is good. What that basically means is that nobody in the company adopted or terminated a pre-arranged trading plan, so nothing to report there. So what's the verdict? GPAC3 Acquisition Corp is really in the hurry up and wait phase, burning through cash while it searches for a target. The big question is, will they find a suitable target within the time limit? This report confirms that SPACs can be tough investments loaded with potential conflicts and risks. What investors need to keep in mind is, can these guys actually find a target? Can the founders be trusted to make a good deal? Is the potential reward worth all the risks? That's what the smart investor should think about. Tien, thanks for watching. If you enjoyed, please subscribe, like and comment.